You already know more about business than you think you do. The moment you sold something, traded something, or even thought about turning an idea into money, you were thinking like someone who runs a business. What most people never get taught is that the way you organize that business changes absolutely everything, from how much you pay in taxes to how much of your own money is at risk if things fall apart. Disclaimer: this content is for educational purposes only and does not constitute financial advice. Number 1. Sole proprietorship. It is the most basic and oldest form of business structure in existence. And if you have ever sold anything on your own without formally setting up a company, you have probably already run one without knowing it had a name. This structure means one person owns the entire business, keeps all the profits, and takes on all the responsibility. Jordan selling handmade stickers online, packing every order at home, and answering every customer complaint alone is a textbook example of this in action. It has existed for thousands of years because it requires almost no paperwork and costs nearly nothing to start. Most places do not require formal registration to operate as one. The major risk is something called unlimited personal liability, which means if the business runs into serious debt or gets taken to court, Jordan's personal savings and belongings could be used to pay for it. That single vulnerability is what eventually pushes most people to look for something more protected. Number 2. General partnership. It forms automatically when 2 or more people go into business together and share in both the profits and the responsibilities without creating a formal legal structure around it. Think of Jordan and a friend deciding to split the costs of buying bulk sneakers to resell, divide the work of listing and shipping, and share whatever money comes in. It requires very little setup, which is why it tends to happen naturally, sometimes without the people involved even realizing they have entered into a legal arrangement. The big problem with this structure is that each partner carries unlimited personal liability, not just for their own mistakes, but for the other partner's mistakes too. If Jordan's partner makes a bad financial decision or causes a legal problem, Jordan is equally on the hook. General partnerships have been used in business for centuries and were one of the primary ways merchants in medieval Europe organized trade relationships. The simplicity is appealing, but the shared risk is something that catches many people off guard later on. Number 3. Limited partnership. It gives a business the ability to bring in investors who contribute money but do not want to be involved in the day-to-day running of things or take on full personal risk. In this structure, there are 2 types of partners. The general partner manages the business and carries unlimited liability, while the limited partners put in money and share in the profits but are only responsible for what they personally invested. Imagine Jordan running an online clothing shop as the general partner, handling everything from sourcing products to managing customer service, while 3 other people each put in money to help fund the inventory without touching any operations. Those 3 people are limited partners. If the business fails, they only lose the money they put in, not their personal assets. This structure became especially popular in the United States during the 19th century as a way to attract investment into large projects like railroads and real estate without requiring every investor to take on full personal risk. Number 4. Limited liability partnership. It is a structure that was specifically designed for professionals who work together, such as lawyers, doctors, architects, and accountants, where each partner wants to protect themselves from being personally responsible for another partner's mistakes. In a regular general partnership, one partner's negligence can expose everyone to liability. This structure changes that. If Jordan and 2 other people run a tax consulting firm as a limited liability partnership, and one of the partners gives a client bad advice that leads to a lawsuit, the other 2 are generally protected from personal financial loss as a result of that specific mistake. Each partner remains responsible for their own actions, but the partnership itself provides a layer of protection against each other's errors. Most states in the United States require professional licensing before allowing this structure to be used, which is why it is far more common in industries that are already regulated. It emerged as a formal legal structure in the early 1990s, following a wave of lawsuits against large accounting firms. Number 5. Limited liability company. It is one of the most popular business structures chosen by new business owners today because it combines the personal protection of a corporation with the flexibility and simplicity of a partnership. When someone forms one, the business becomes its own legal entity, which means it can own property, sign contracts, and be sued without those consequences automatically reaching the owner's personal finances. Jordan launching a small online resale shop and registering it as one of these means that if a customer sues the business over a damaged shipment, Jordan's personal bank account is not automatically on the line. Profits and losses pass through directly to the owner's personal tax return, which avoids the double taxation issue that comes with other structures. It was first introduced in the United States in Wyoming in 1977 and slowly spread across the country after the Internal Revenue Service clarified its tax treatment in the 1990s. Today, it is used by everyone from solo freelancers to large multi-owner operations. Number 6. Corporation. It is a legally independent entity that is completely separate from the people who own it, which is what makes it unlike almost any other business structure. Once a corporation is formed, it has many of the same legal rights as a person. It can enter contracts, own assets, take on debt, and be sued, all without those actions automatically affecting the personal finances of its owners. The owners of a corporation are called shareholders, and they own pieces of the business called shares or stock. Jordan investing money into a corporation by buying shares is not the same as Jordan running a sole proprietorship because Jordan's personal liability is limited to the amount Jordan invested. Corporations require more paperwork, have formal governance requirements like a board of directors, and are subject to more regulation than simpler structures. The first modern corporations appeared in 17th century Europe, when governments granted special charters to trading companies like the Dutch East India Company to pool resources and share risk across large numbers of investors the first time. Number 7. S Corporation. It is a special tax classification available in the United States that allows a corporation to avoid the double taxation problem that normally comes with being incorporated. In a standard corporation, the business pays taxes on its profits, and then when those profits are paid out to shareholders, those shareholders pay taxes again on that income. An S corporation eliminates that second layer of taxation by allowing income and losses to pass through directly to the shareholders' personal tax returns. Similar to how a partnership works. Jordan forming a small tutoring business and electing this tax status means the business itself pays no income tax. Instead, Jordan reports the business income on a personal tax return. There are strict eligibility rules, including a limit of 100 shareholders, a requirement that all shareholders be United States citizens or permanent residents, and a restriction to only one class of stock. It was created by Congress in 1958 to help smaller businesses compete without being overwhelmed by tax burdens. Number 8. C Corporation. It is the default corporate structure under United States tax law, and the one most large, publicly traded companies use. Unlike an S corporation, it pays taxes at the corporate level, and then shareholders pay taxes again on any dividends they receive, which is the double taxation many people try to avoid. So why do so many businesses choose it? Because it comes with almost no restrictions on ownership. It can have unlimited shareholders, can bring in foreign investors, can offer multiple classes of stock, and has no cap on how large it can grow. Jordan building a technology startup with plans to eventually take it public and bring in venture capital from around the world would likely need this structure because it gives the most flexibility for large-scale investment. Most of the companies you have heard of, the ones listed on stock exchanges, are C corporations. The structure became foundational to American capitalism throughout the 20th century as companies needed access to broader pools of investment to fund major growth. Number 9. Nonprofit organization. It is a type of organization formed to serve a mission rather than to generate profit for owners or shareholders. Any money it brings in through donations, grants, or services is supposed to go directly back into fulfilling the purpose the organization was created for. Jordan starting a nonprofit to provide free coding workshops for students in low-income neighborhoods would organize the business this way because it allows the organization to apply for tax-exempt status, which means it generally does not pay federal income tax in the United States. Donors who give money to it may also be able to deduct those gifts from their own taxes, which makes it easier to attract support. Running one does not mean no one gets paid. Staff and directors can receive salaries. The key difference is that there are no shareholders taking home profits at the end of the year. The organization must also meet strict requirements and file detailed reports with the government to maintain its tax-exempt status and prove it is truly serving its stated mission. Number 10. Cooperative. It is a business owned and democratically controlled by the people who use its services or work within it, rather than by outside investors who are simply looking to make money. In a cooperative, every member typically has an equal vote in major decisions, regardless of how much money they have put in. Jordan joining a group of student entrepreneurs to form a cooperative buying club, pooling money together to purchase inventory at wholesale prices and sharing the savings equally, is a practical example of how this structure works at a small scale. Profits are usually returned to members based on how much they participated rather than how much money they invested. The modern cooperative movement traces back to Rochdale, England in 1844, when a group of working-class weavers pooled small amounts of money to open a store where they could buy food at fair prices. Today, cooperatives operate across nearly every industry, from agriculture to banking, and are found in virtually every country in the world. Number 11. Franchise. It is a business arrangement where a parent company, called the franchisor, gives another person or group, called the franchisee, the legal right to operate a business using the parent company's brand, products, and systems in exchange for fees and a share of the revenue. Jordan paying an established food brand to open and run one of its restaurant locations in a new city would make Jordan a franchisee. Jordan gets to use a name people already trust, follow a proven playbook for running the business, and receive training and support from the larger company. In return, Jordan pays an upfront franchise fee, ongoing royalties on sales, and must follow strict rules about how the business is run. The franchisor benefits by expanding its reach without having to fund and manage new locations directly. Franchising as a formal system grew significantly in the United States after World War II, particularly through the rapid expansion of fast food chains across the country throughout the 1950s and 1960s. Number 12. Joint venture. It is a temporary business arrangement where two or more separate companies or individuals agree to work together on a specific project, while remaining independent from each other outside of that project. Each party contributes resources such as money, technology, skills, or connections, and shares in both the profits and the risks of the shared effort. Jordan's custom print shop joining forces with a local clothing brand to co-design and sell a limited collection together would be a joint venture. Both sides bring something unique to the table, the printing expertise from Jordan's side and the audience and brand recognition from the clothing company's side. Once the collection sells out and the project ends, both businesses go back to operating entirely on their own. Joint ventures are especially common in international business, where a foreign company partners with a local business to enter a new market by combining the foreign company's product or technology with the local partner's knowledge of the market and existing relationships with customers. Regulators. Number 13. Holding company. It is a business that exists primarily to own controlling interests in other companies rather than to produce goods or provide services directly to customers. Think of it like a parent sitting above a group of children. The holding company owns pieces of several businesses beneath it, controls major decisions across them, and collects income from their profits without being involved in the daily operations of any single one. Jordan inheriting a family business structure where one company at the top owns controlling stakes in a restaurant chain, a real estate firm, and a logistics company would be dealing with a holding company structure. One major advantage of this arrangement is liability protection. If one of the companies beneath the holding structure gets sued or goes bankrupt, the damage generally does not spread directly to the holding company or to the other businesses it controls. Large corporate groups around the world, including many well-known conglomerates, use this structure to manage diverse portfolios of businesses under a single umbrella of ownership and control. Number 14. Conglomerate. It is a large corporation that owns a collection of businesses operating in completely different and unrelated industries, with the idea being that spreading across multiple sectors reduces the risk that a downturn in any one industry can sink the entire organization. If technology sales slow down, but the food division is booming, the losses in one area can be offset by the gains in another. Jordan, growing a business empire over many decades that eventually controls a tech company, a hotel chain, an agriculture supplier, and a media outlet would have built a conglomerate. This type of structure became enormously popular in the United States during the 1960s when investors and executives believed that diversification across unrelated industries was the smartest long-term business strategy. Some of the world's largest conglomerates today are based in South Korea, Japan, and India, where family-controlled corporate groups called chaebols and keiretsus have shaped national economies for generations. Managing one requires significant executive talent and a very clear organizational structure. Number 15. Social enterprise. It is a business that is built specifically to address a social, environmental, or community problem while also generating enough revenue to sustain itself financially. Unlike a nonprofit, it is not purely donation dependent and is designed to earn money through its products or services. Unlike a traditional for-profit business, its primary mission is the social impact it creates, not the profit it generates for owners. Jordan building a company that trains unemployed teenagers to repair and resell electronics, using the revenue to fund more training programs while also turning a small profit, would be operating a social enterprise. This type of organization sits in the space between the nonprofit and the for-profit world, taking the best elements of both. It grew significantly as a recognized business category during the 1990s and 2000s as entrepreneurs and investors began looking for ways to tackle problems that governments and charities alone were not solving. Many social enterprises operate in areas like fair trade, clean energy, affordable housing, and workforce development. Number 16. Benefit corporation. It is a legal business structure available in many United States states that formally requires a company to consider the impact of its decisions on workers, communities, and the environment, not just on profit. It changes the legal foundation of what a corporation is supposed to prioritize. In a traditional corporation, executives have a legal obligation to maximize value for shareholders, and acting against that can expose them to lawsuits. This structure gives legal cover to leaders who want to balance profit with purpose. Jordan running a clothing company, registered as one of these, would be legally protected in making choices like paying workers above market wages or using more expensive sustainable materials, even if those choices reduce short-term profits. It is different from a B Corp certification, which is a private certification given by an organization called B Lab to companies that meet certain social and environmental standards. The legal structure and the certification can exist independently, though many companies pursue both. Maryland became the first state to authorize this structure in 2010. Number 17. Professional corporation. It is a specific type of corporation designed for licensed professionals who are required by law to be personally accountable for their own professional conduct, even while enjoying some corporate benefits. Professions like medicine, dentistry, law, accounting, and engineering typically use this structure when they want to operate as a corporation, but their licensing boards require them to retain personal liability for malpractice or professional errors. Jordan qualifying as a licensed architect and setting up a firm under this structure would mean Jordan gets corporate tax benefits and some protection against general business liabilities, like a vendor dispute or a lease problem, but would still be personally responsible if a building design caused structural harm. This distinction matters because regulators and licensing boards believe that allowing professionals to fully hide behind a corporation could reduce accountability in fields where errors can seriously harm people. The rules around what protections this structure provides vary significantly from state to state and from profession to profession. Number 18. Public company. It is a corporation that has offered shares of itself to the general public through a stock exchange, which means anyone with a brokerage account can buy a small ownership stake in it. Going public through a process called an initial public offering gives a company access to enormous amounts of capital from millions of investors around the world, which can fund expansion, research, acquisitions, and operations at a scale that private funding rarely reaches. Jordan, taking a successful e-commerce business through this process, would mean issuing shares, setting a price for each one, and allowing the public to buy in on the first day of trading. After that, the company's financial results, major decisions, and internal information become subject to strict public disclosure rules enforced by regulators like the Securities and Exchange Commission in the United States. Shareholders now have a voice in major decisions. Stock price becomes a daily measurement of how the market feels about the company's direction, and that pressure shapes how leaders make decisions in ways that do not exist in private companies. Number 19. Multinational Corporation. It is a business that operates in multiple countries simultaneously, with production facilities, offices, employees, or sales operations spread across national borders, often organized and managed from a central headquarters in one country. This type of structure allows a company to access new markets, take advantage of lower labor or production costs in certain regions, benefit from favorable tax environments in different countries, and reduce its dependence on the economic health of any single nation. Jordan expanding a consumer electronics brand from its home country into Southeast Asia, Europe, and Latin America. Setting up regional offices and local manufacturing in each area would be building a multinational corporation. Managing one involves navigating different languages, legal systems, currencies, cultural expectations, and political environments all at once. The rise of multinationals accelerated dramatically in the second half of the 20th century as global trade agreements lowered barriers and communication technology made it possible to coordinate operations across continents in real time. Today, the largest ones employ hundreds of thousands of people across dozens of countries. Number 20. Decentralized autonomous organization. It is one of the newest and most unusual types of business organization to emerge in recent years, built entirely on blockchain technology and governed not by executives or a board of directors, but by rules written into computer code and decisions made by token holders through digital voting. There is no central office, no CEO, and in many cases, no country in which it is legally registered. Jordan joining one that pools money from contributors around the world to fund independent music projects. With every major spending decision voted on by the members using digital tokens, would represent a completely different way of thinking about what a business can be. Supporters argue that it removes the need for trust in any one leader because the rules are enforced automatically by code. Critics point out that it creates serious questions about legal accountability, security vulnerabilities, and how disputes get resolved when no court system has clear jurisdiction. The concept emerged from the Ethereum blockchain community in the early 2010s and continues to evolve rapidly.